Okay, so those are our two high time frames. Again, we're not going to be in a trade for a month. We're not looking to the monthly to make sense of how we're going to pull a trade out of the monthly. What we're looking for is the probability associated with it. That's it. So when these two timeframes are aligned, we know that there's agreement there, and the higher timeframes, if we're looking for the trend phase on the 3 market cycles, who do we need to participate in order for that to turn into something? We need the higher timeframes to participate, right? Otherwise, it's going to come back into the range. We don't want to deal with that. We want the trend. We want to find the trend in the best, most risk-controlled way possible. So if I know what the intent is on these guys right here on the higher timeframes, if I know what the intent is, then that's, again, why we have the directional bias. I'm looking for that momentum candle away from our entry time frame. This is telling me the clue. It's like, hey, this is our intent. High likelihood. Until these guys give up, this is where it's going. So if I want to be up 50 or 100 pips at the end of the week, right? Monday through Friday, and we want to be flat for the weekend, especially in FTAP, right? We want to be flat for the weekend. Well, it would suit me really well to know the potential direction of the week. And if it's in line with the monthly, this has a much higher chance of closing in the monthly direction. If it's out of alignment, well, then, we're kind of in that big range territory, right? We have the monthly and the weekly. These are in agreement. Okay. Now we got our 30-minute chart. Always starts with the first phase of the market, which is the contraction phase. That's going to put forth our value. So here's our playground, right? This is where we figure it all out. This is already given us a directional bias. This is just simply telling us these are in agreement. We need these guys to make sure that, we're trying to get down to here. We want to work this distance down to here. And we have a predetermined expectation of this box because of that. Right? It's going to go from here to here, some way, somehow, and in some time. Now, what comes out of here is going to be how we position ourselves. So if we know this is fair market value on the 30-minute chart, okay, let's say we start crawling out here, this is going to be hard to do anything with right here. And sometimes it might go from here to here, direct breakout. That's just the way it goes. So this is going to be hard to do something with, but if we can ideally get back up here, we're coming through liquidity right there, right? So that's where we start to get in the zone, is above value right here. So this is where we start to figure out, can we deploy our first position? If the weekly and the monthly are in alignment, and again, this is a 30-minute chart. If those are in alignment, high likelihood any activity above this value is going to end either at value or below. Because what is the simple reason why this cannot continue on forever is because those guys their commitment is that way. And so while the 30-minute and the weekly, there's some separation. So you might get the 4-hour to come in and push it up a little more, and maybe the daily push it up. And that's where you guys, you'll try to stick some of these entries and you'll be like, oh, it went a lot farther than I thought. Again, in order for this to go up here, we need commitment from the hour. We need commitment from the 4-hour, and we need commitment from the daily. Unless these guys come in right here, this is going right back to there. And again, it simply comes down to 30-minute. The value was established by the 30-minute players. And unless these guys get involved, which are going to not only put money into the market, they're going to bid the price up, but they're also going to hold on a longer time frame. Unless we get their activity, this is coming right back to here, because 30-minute traders only trade for 30 minutes, right? They're just going to come up, they're going to prop the price up a little bit when there's no one else to come into this little miniature. You think of this little miniature Ponzi scheme right there. When there's not another 30-minute trader to come in, it falls apart. There's no one else to carry the bag. The only person that can carry the bag is a higher time frame. We expect, because the monthly and the weekly are cluing us in to where the commitment is on the higher time frames as a whole. Even the daily and the 4-hour can't compete with these guys. So we know that everything above value is going to eventually come back down here. So we got to navigate in. So right here, ideally, you're going to want to put in your first position just somewhere here. And the best that you're probably going to be able to do is, a couple of things, either a liquidity line, getting a reaction off a liquidity line, or just trying to navigate the turn as best you can. So let's just say that you put it in, your first position went in right here at that turn. So that's your first position right there. Obviously that didn't work out. Now you're down a little bit. A very high likelihood that's going to happen. And you know what? It's probably going to happen. You're going to go down even more than that. High likelihood. Okay. So you're going to be navigating this. This is the point of breaking the position into 3, and then you guys can work out the math on what works for you. But I think it should be, 3 positions is good. There's going to be other things in and around this. You might have other previous expansion lines up in here. So maybe we're working up in there off of that previous expansion line level because we have those values. Remember, if the trend's in a hold, you're going to see values stack in that trending direction. So there's going to be other things over here that you're judging this move based upon, right? So you can use those to your advantage. If there's nothing there, then you're going to kind of have to navigate the candle. Maybe there's liquidity line, a localized liquidity line. Those are things that you'll have to kind of work out, depending on the situation, right? You just have to see what's available as far as framework goes. So as you get in there, maybe you lose on this position, maybe you hold. If there is an expansion line here, maybe there is between here and here, maybe there is, 30 pips between there. So when you enter right here, that okay, I know that if this price goes much above that, what is my weekly going to look like? What's my daily going to look like? You judge those higher time frames. And if those are rotating hard by the time you get out of here, then you're like, maybe I should close all positions at this level. So you're working that out in advance before you ever pull the first trade. If you're not getting good risk to reward in this situation, whatever framework's available, if you're not getting good risk to reward, don't take the trade. There's no reason to. Let it be favorable, for you. So this right here, let's say that's your first position. It does end up rotating off of this previous value level that's already been established. Okay, now it's coming back. Your second position comes in at this rotation. Okay, now you got to average between these 2 positions. Okay, as you come back down through, what needs to happen is we always are trying to get through value, because the fulfillment of this trade is based on, we're dealing with this localized expansion. We have a predetermined expectation based on our directional bias that this box is the price action is going to come out of here and it's going to end at a lower box. And we're going to call that the trend, right? That's that phase that we're looking for. So as this comes out of there and we're looking for it to get through value, we'd like to see an aggressive move through this. When we see aggressive moves through value, that means that there's usually some commitment behind it. If it's just kind of coming down and it just kind of wants to bounce off that, that's something we need to think about. So as we get down through value, we want to see an aggressive move and we want to see it come down. And again, for this to sustain, we need higher time frame players than the 30-minute to come in and sustain this move. There's a high likelihood that this right here, this whole situation coming down through value right here, there's a high likelihood that that's going to take place because we've already done the homework here. We had this expectation. At the moment this box was formed, we had a predetermined expectation this was going to work out some way like this. You guys notice that multi-leg expansions, do they not all look relatively the same? They have different range sizes, but can you guys, you've been in this program long enough to now to know, like, you could spot that. You could probably spot it without even looking at our software or the boxes, right? You could just see it. It's like, okay, I see the contraction. I could see it whip. I could see it doing that. So, we had that predetermined expectation. As it comes down through, we're looking for that sustained movement. Once we get through here, through that value level, we're not going back above here. This is our safe entry navigating into this move is dispersing 1, maybe 2, maybe 3 positions in and around here to the best of our ability, putting these couple of positions with the expectation we're getting back to gravity. And then when we get back to the center of gravity, we want to see a forceful movement down through. At that point, whatever profit you made here, you're not giving back. That is yours. Anyway, as that works down, you're getting down, and then eventually that's the full cycle that we're trying to work.